Jason Simpkins is pitching a new defense stock and he claims this one is the next Palantir. I reveal it in this video for free so you don't have to buy Simpkins' newsletter. No paid or proprietary info is given away here. It's all guesswork based on clues from Simpkins' publicly available sales presentation. Before we do anything, let's look at Simpkins' track record. In September 2020, Simpkins recommended visibility as a COVID stock, and the investment went up 1,500% shortly after. This was a great pick. In March 2023, Simpkins recommended augmented reality stock Copen, and it's up a pretty healthy amount since. He recommended defense stock Kratos back in September 2024, and this stock has done well too. He picked Joby Aviation in October 2024, and this is another winner. In January 2025, he recommended two more stocks, and the first was Palantir. It's up 85% since. The second pick was C3 AI, and this one has been bad so far and is down 30%. Let's shift back to the teaser now and figure out the stock being pitched. Here's how Simpkins starts it. A former US military analyst says it's like a school of robotic piranhas flying in perfect formation over Chinese territory, and America is dangerously unprepared. That's why Trump just launched the $5.3 trillion Golden Dome Defense Initiative, an AI-powered missile shield designed to protect America. And one tiny company is at the center of it all, with groundbreaking technology that could stop the swarm and send its stock soaring. Simpkins believes China's growing drone technology is a massive threat to America. He says, "The future of warfare is swarming, and China is years ahead. Forget jets, forget tanks. The battlefield is shifting from missiles and bombs to drones and bandwidth. China's military-industrial complex has fused drone innovation with AI acceleration, and the results are jaw-dropping. Swarm behavior learned from nature, perfected by code, removed deployment from mobile trucks or underground bunkers, onboard AI brains that can reassign roles mid-mission if one drone goes down, lethal autonomy, drones that can hunt and strike without human input. This is the kind of tech that could cripple aircraft carriers, disable entire power grids, or drop from the sky on presidential motorcades." And Simpkins claims America is pouring a lot of money into drone defense to prepare. Simpkins claims, and guess who's trying to keep up? The US is scrambling to respond. A new $500 million Pentagon initiative aims to fund domestic swarm drone programs, but many believe we're 5 to 10 years behind China in swarm capability. "We underestimated the leap from drone to drone swarm, and now we're racing to close a gap we didn't know existed," said a former Joint Chiefs staffer. "And on the front lines of Ukraine, we've already witnessed the devastating power of drone warfare in real time. And according to Simpkins, we've spent trillions preparing for the wrong war." And Simpkins claims Trump is going to fix this, and he says, "That's why President Trump just launched the Golden Dome Defense Initiative, a $5.3 trillion AI missile shield. And one little-known defense tech firm is poised to become the backbone of the largest defense initiative in American history." Let's look at specific clues Simpkins left now. Simpkins says this about the company he's pitching, and at the center of it all is one tiny company, a mission-critical defense contractor whose tech is already embedded in over 300 programs, including the F-35 fighter, Patriot missile system, and Reaper drones. It's the #1 provider of anti-drone and anti-hypersonic tech to the Pentagon. It supplies critical systems to defense giants Lockheed Martin, Northrop Grumman, Raytheon, Boeing, and even the US Space Force. This isn't a startup hoping for a contract. This is a proven supplier with a $1.33 billion backlog, deep ties with every major defense contractor in America, and a long track record of innovation. Simpkins also says the company is 84x smaller than Palantir. Palantir is worth around $300 billion, so we're looking at a market cap under $10 billion. Additionally, Simpkins says this company is a 40-year veteran of US defense. Eventually, Simpkins showed pictures of this company's tech, and this allowed me to figure out the stock. The company being pitched here is Mercury Systems. I was actually stumped until I saw these pictures. I did a reverse lookup, and they both are Mercury System products. The first is a signal jammer from Mercury, and the second is a chip Mercury offers. All the other clues fit perfectly as well. Mercury Systems is a US-based aerospace and defense technology company that specializes in secure mission-critical solutions. What sets Mercury apart is its commitment to delivering open architecture solutions with built-in security for programs like the F-35, Patriot missile system, and various classified platforms. Its products are designed, built, and tested in the US, which has made it a trusted supplier for defense giants like Lockheed Martin, Raytheon, Northrop Grumman, and Boeing. The company often acts as the behind-the-scenes tech provider that integrates advanced signal processing and sensor fusion into next-gen military systems. Here are the top 5 things to know about this company before investing, and after I'll tell you if I'd buy. First is the comeback play, a turnaround in progress, not yet complete. Mercury Systems was in rough shape after a disastrous fiscal 2024 where revenue dropped over 14% and net losses ballooned to more than $137 million. The company had struggled with supply chain issues, operational inefficiencies, and underwhelming contract execution. But everything changed when Bill Ballhaus stepped in as CEO in late 2023. He's been aggressively refocusing the business on what he calls the four core priorities: execution, cost discipline, free cash flow, and organic growth. Under his leadership, Mercury has started to stabilize. In Q1 FY 2025, bookings rose 29% year over year, and the book-to-bill ratio hit 1.21, meaning they're getting more new orders than they're fulfilling, a strong indicator of demand. However, this is still a turnaround play, and the company is guiding for flat revenue in fiscal 2025. So, investors hoping for a quick rebound might be disappointed. This is more of a multi-year recovery story that hinges on consistent execution. Second is defense goldmine, deeply embedded in critical U.S. military programs. Mercury isn't just another defense contractor. Their technology is already embedded in over 300 key defense programs, including some of the most advanced platforms like the F-35 fighter jet, the Patriot missile system, and Reaper drones. The company designs secure microelectronics, sensor systems, and processing solutions, all customized for U.S. military applications. What sets Mercury apart is that they don't just assemble or distribute. They own a vertically integrated supply chain with DMEA-accredited facilities, meaning they're one of the few U.S.-based firms cleared to handle the nation's most sensitive defense electronics. As tensions rise globally and the U.S. pushes to onshore its defense chip capabilities, Mercury is positioned as a go-to provider. This strategic alignment with government priorities provides a long-term tailwind that most small-cap companies simply don't have. Third is strong bookings, but weak bottom line, the profitability puzzle. Despite strong orders and a growing backlog, now at around $1.34 billion, Mercury is still bleeding money on a GAAP basis. In its most recent quarter, the company posted a net loss of $17.5 million and burned through over $20 million in free cash flow. Even though adjusted earnings before interest, taxes, depreciation, and amortization improved year over year, the margin was still thin, around 10.5% to 11.7%. The big issue is cost structure. Overhead, R&D, and integration expenses from prior acquisitions have been eating into profits. Analysts expect the company to finally swing to profitability in fiscal 2025, projecting EPS of 0.42 compared to a 0.69 loss in 2024. But for that to happen, Mercury needs to prove it can not only win contracts but execute them profitably. Until the bottom line catches up to the top line growth, the market may remain skeptical. Fourth is Wall Street is divided. Analysts love the story but not the execution. Mercury is a battleground stock. Truist recently rated it a buy with a $60 price target, while Goldman Sachs slapped it with a sell and a much lower $33 target. That's a wide gap, and it speaks to the uncertainty around whether this turnaround will actually play out. Some analysts are betting that Mercury's exposure to secure military tech and the new CEO's strategy will boost margins and unlock shareholder value. Others worry that the company's issues are deeper and will take longer to fix than the market expects. On average, Wall Street sees the stock as a moderate buy, with a consensus price target just under $50, slightly below where it trades today. So while some bulls see more upside ahead, this isn't a slam dunk. It's a high-risk, high-reward setup. Fifth is insider moves and technical strength, reading between the lines. One thing that's been catching investors' attention is insider activity. EVP Steven Rattner recently sold about $98,000 worth of stock. Not a huge amount, but notable. The company said it was to cover taxes, not a signal of declining confidence. Still, anytime execs sell during a supposed turnaround, it raises eyebrows. On the other hand, from a technical perspective, the stock has broken out past its 50 and 200-day moving averages, showing strong momentum. It recently hit a new 52-week high, which could attract more institutional money, especially if future earnings keep beating expectations. This combination of insider selling and bullish chart signals presents a mixed picture. It's a reminder that fundamentals and technicals don't always agree, and you need to be clear on which one you're betting on. As for me, defense stocks seem like a solid bet right now, especially with the uptick in global geopolitical tensions. You have the ongoing conflict between Russia and Ukraine, and now rising tensions between Israel and Iran, a situation that could potentially draw in the United States. Even if the US doesn't become directly involved, it will almost certainly ramp up military aid and weapons supply to its allies, particularly Israel. Betting on war always makes me a little uneasy. It's hard to ignore the moral weight of profiting from conflict, even if the sector is well positioned for growth. Unfortunately, war and instability often drive defense spending, and as uncomfortable as it is to admit, that spending can fuel strong returns for investors in the space. That said, even if I set aside my ethical reservations about investing in defense, I'd probably still pass on Mercury Systems. They've been a very inconsistent performer over the years, and nothing about their recent trajectory makes me confident they'll deliver sustained success going forward. The stock currently looks expensive relative to its earnings and cash flow, and if the company experiences any stumbles in execution or fails to meet growth expectations, the stock could tumble quickly. If you're bullish on defense but don't want to risk picking a single company, the Invesco Aerospace and Defense ETF might be a smarter alternative. It offers broad exposure to the industry, has performed well historically, and is likely to continue benefiting from elevated global defense budgets. Plus, it throws off a modest dividend, which adds a little extra incentive for long-term holders. And don't forget to click the link in the description to check out AlphaPick. Right now, they're running their biggest sale of all time, and you can get $100 off this amazing service. Remember, I've reviewed over 100 stock picking services, and this is the only one that consistently beats the market, nearly tripling the returns of the S&P since inception. So again, make sure to click the link in the description and get $100 off this incredible deal.